Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think there's a whole range of developments that are worth discussing. In the US, obviously, we had the US GDP for the final quarter of the year, and I think it might be valuable to unpack some of that data. We also had the core PCE inflation number, which I think is going to be important from a monetary policy perspective. So I think it might be useful to just quickly highlight what happened to that number, and then clearly the Supreme Court decision to rule against President Trump's Liberation Day tariffs and the implications of that. So quite a bit developing in the US. In South Africa, we had our inflation numbers surprised a little bit on the upside. Not too much of a problem, but there are one or two risks that are developing within the inflation data that I think are perhaps important to discuss. And then we also had our retail sales numbers for the month of December. Generally a little bit disappointing, although when you look at 2025 as a whole, retail sales did exceptionally well, growing at 3.7%. So even though December was a little bit disappointing, I don't think it detracted from the outperformance of consumer spending or retail activity. I don't think it's worthwhile going through the retail sales in a lot of detail, so I think we just focus on the SA inflation data and then some of the US key economic data points. So let's start with the key economic developments in the US. We had the fourth quarter GDP performance. It came in at a growth rate of 1.4% measured quarter on quarter. That was well below expectation. The market was expecting the growth rate to be up at 2.8%, so significantly below what most economists had anticipated. If I break down the detail, the reason for the underperformance, I think, is undoubtedly the impact of the US government shutdown. Remember, the government shutdown started at the beginning of October, lasted, I think it was 43 days, and obviously had a negative effect on overall economic performance. And the US Bureau of Economic Analysis said that the government shutdown subtracted a full 1 percentage point from the US's GDP performance in the final quarter, which means that if it wasn't for the shutdown, the US economy would have grown by at least 2.4%. Still below the estimate of 2.8%, but 2.4%, a very decent outcome. If I look at the other components within the GDP estimate, you would say on the whole, not a lot that stood out as being particularly robust. There was some general weakening of consumer activity, and you can imagine that would occur when you have a shutdown and a huge number of people are being forced to stay at home and they don't receive pay for the period of the shutdown. They do get back pay, but for the time that they are in the shutdown, they don't receive payment. So obviously that would tend to put consumer activity under a little pressure. There was obviously ongoing fixed investment, but again, if you break down the fixed investment, it was very, very much focused on data centers and AI investment. Outside of that, you would argue there wasn't a whole lot of fixed investment going on. So I would say the underlying growth rate in the US, a little bit lackluster, not problematic, but not as robust as they've had in recent years. And then obviously the government shutdown exacerbated that. That's why you end up with the 1.4%. If I look at the growth rate for last year in its entirety, the US economy grew at 2.2. Now, 2.2 is a decent outcome, but if you consider that the long-term average is 2.5%, so it was below the long-term average, and then if you look at the years leading up to the Trump presidency, the US economy was typically growing at about 2.6, 2.7, 2.8%. So below the recent growth rate, and overall I would say somewhat disappointing. And you see that disappointment in the labor market. If you think that the US economy only added an average of 15,000 jobs a month last year, which is well below what it's been adding previously. And clearly the investment in AI is what's giving the US economy its overall growth rate so that it doesn't look particularly bad. But as I say, if you drill down into the sub-data, then I think you would arrive at a conclusion that says the underlying performance of the US economy is a little bit lackluster and clearly be negative in impacted by the policy uncertainty from the Trump administration, and therefore the negative effect of the tariffs and changes in tariffs, and generally a little bit of hesitancy about the willingness to invest, expand, and employ. The other key data point was PCE inflation. It's for the month of December, but the reason it's important is because it's a key focal point for the Federal Reserve, particularly the core PCE inflation. And what we saw with that number was an acceleration above expectations. During the month, core PCE inflation went up by 0.4%. That is higher than what was anticipated and higher than the long-run average. The market was thinking an increase of only 0.3%. And so that pushed the annual rate of core PCE inflation up from 2.8 to 3%. And the problem is 3% is just too far away from the inflation target of 2%. And so that will feed into ongoing hesitancy by the Federal Reserve in terms of further interest rate cuts. And I think that's going to ensure that the interest rates in the US remain on hold until Powell leaves office. He exits as chairman of the Federal Reserve in the middle of May. He hasn't indicated whether he's willing to still stay at the Federal Reserve or whether he exits the institution in its entirety, but his role as chairman ends, and we now know that Kevin Walsh is going to be appointed as the next chairman. But at this stage, you would say, given that the inflation data is remaining sticky, closer to 3% than the 2%, it is going to set up for a difficult environment for the Federal Reserve if you're looking for interest rate cuts. Even though you change the chairman of the Fed, I think it's going to be a problem for the Fed to be aggressive on rate cuts. They'll be seen as giving up on the inflation target. Potentially, people will question the independence of the Federal Reserve. So I think the Federal Reserve will have to continue to adopt a fairly cautious approach to further interest rate cuts. That doesn't mean there isn't scope to cut rates. I think there's scope to cut rates 2 more times this year, and so that's entirely feasible. But what doesn't seem likely is an aggressive interest rate cutting cycle with a change in the chairman of the Fed. Unless the inflation numbers start to come down very meaningfully from current levels, I think you're going to look at a Federal Reserve remaining fairly nervous about the inflation outcomes and the lack of progress of moving down to the 2% level. The last thing to mention on the US is the Supreme Court decision to rule that the Liberation Day tariffs were effectively illegal. They ruled that President Trump exceeded his authority. That vote was a 6-3 vote against President Trump effectively. And so what it did was to say all of those tariffs which were increased must go back to the level they were at prior to Liberation Day. Now that isn't every single tariff. It applies to, I think, something like 60 to 70% of the tariffs. So that's a significant blow for the Trump administration. What President Trump then did very quickly after that is to announce new tariffs under a different section I think 122, which allows him to increase tariffs for a shorter period of time, up to 150 days. And so he effectively then put the tariff at 15% for the next 150 days on all items being imported in the US. Clearly, that's going to create a whole lot of uncertainty, another bout of concern about what's going to be the long-run implications of this. We still don't know whether or not the Trump administration has to pay back the money they received in terms of the tariffs so far. If they do have to pay that back, that's a significant amount of money. It's estimated to be somewhere between 130 billion and 170 billion. That's quite a bit for the government to come up with, and they would have to then reimburse those companies that paid the duties, the higher duties in the first place. So the Trump administration says they're going to look into all of this and come up with another way to implement tariffs. So they're not backing down from their desire to have higher tariffs. But clearly what they've got to do is find an alternative way of implementing those tariffs. And at this stage, we're not entirely sure what that's going to look like, how effective it would be, what sort of tariff levels will end up being preside or being persistent. So a huge amount of uncertainty. I think this is going to lead to quite a lot of volatility in import activity. It's also going to lead to big changes in inventory levels as companies try and benefit from any particular tariffs that are significantly lower than they've been previously, and see whether or not they can improve their bottom line as a consequence. So another whole bout of uncertainty, which I think is very unfortunate, and from our perspective, that uncertainty has contributed quite a bit to the overall lackluster performance of the US economy over the past 12 months. Lastly, let's talk about South Africa's inflation data for the month of January. In general, I think the numbers surprised a little bit to the high side, but overall, the annual rate of inflation remains well under control and very close to the new target of 3% with a 1% band either way. So during the month, the CPI went up by 0.2%. The market was thinking an increase of 0.1%. I think, to be fair, the 0.1% was always going to be a little bit optimistic, and so 0.2% a very decent and credible outcome. It allowed the annual rate of inflation to slow from 3.6 to 3.5, and at 3.5%, that's a good outcome. It suggests we're very close to the point target of 3% and certainly within the 1% leeway. And if I look at some of the underlying dynamics, they also seem well under control at this stage. But there are one or two things we need to just be mindful of. So the first is that core inflation went up 0.3% in the month. That's a little bit higher than what was anticipated. And that ended up pushing the core inflation, the annual rate of core inflation, up from 3.3 to 3.4. So again, 3.4, very acceptable, but there's a little bit more pressure within that particular metric. And some of the pressure that we see developing in our data is simply the numbers are off a low base. We've got a number of categories where inflation has been incredibly subdued. And once you get that, then you always become nervous that if there is to be some sort of currency weakness, an increase in the oil price, that all of that can quickly feed into a little bit more inflation. And I think we've got some of those dynamics at play. That doesn't mean that I think inflation is going to become problematic. Not at all. Over the next 2 years, I've got inflation staying pretty much in the 3 to 4% range. But some of the key benefits that have allowed inflation to get down to these levels, they will probably fade over the next 12 months. And therefore, it's going to be important that the Reserve Bank is able to cement the lower inflation expectations and ensure that pricing starts to become anchored much closer to 3% than what it was previously, which is at around, I guess, the 4.5%. If I look at the broad range of numbers that were measured in January, there's nothing that really jumped out at me other than the meat prices. Obviously, meat inflation now up at over 13% year on year, and that I think reflects mostly the foot and mouth disease. The government has been fairly lackluster in terms of implementing the vaccines, and so I think there's going to be a bigger effort to try and make progress there. And obviously, once you've got a huge outbreak of foot and mouth, very, very difficult to control that. And so there would generally be a shortage of meat supply, which then pushes up the price. I think consumers will try and adjust how they consume meat, look at alternatives like chicken, etc. But it does create some price pressure, at least in the short term. If I look at the other areas, there was a bit of an increase in financial service charges during the month. That number was slightly above 4%. Again, not quite at the level that you would ideally want given the new inflation target. There was also a little bit of pressure in the hotel industry, and I think that in part reflects the buoyancy of our tourism sector. If I look at international tourism, it has recovered very nicely and is in actually very good shape, and so it can't be too surprising that there's a bit of pressure on hotel costs. Again, very difficult to get those numbers to go up by only 3%. So there are a range of categories which we're going to be watching very carefully over the coming months just to see whether or not the 3% target takes hold. In other words, do people systematically now put in a 3% increase instead of a 4 or 4.5? And that's what we need in order to ensure that over the medium term that we are able to benchmark South Africa's pricing around 3%, therefore allowing the Reserve Bank to cut interest rates much more meaningfully. If 3% becomes the norm, then there's lots of scope to cut interest rates. You could easily cut rates 4 times, 25 basis points each, and you would still not have a problem with interest rates being too low. You could still argue that interest rates at that point are somewhat restrictive. But that all depends on inflation being embedded at close to the 3%, and that the Reserve Bank needs to feel comfortable that that has become most people's inflation expectations. So I think this is work in progress. You have to applaud the Reserve Bank for the decision to move the inflation target, applaud them for the progress they've made in being able to keep inflation well under control. But it isn't a certainty, and we've got to be very careful to examine the data carefully in this transition phase as we transition from a 4.5% type inflation rate to a 3% inflation. You've got to be careful that at some point it doesn't revert back to its historical norm, and I think we're right in the midst of that transition phase, and therefore it's more important to focus on the upside risks than any other component within the inflation basket. So good progress so far, nothing wrong with it. Hope it continues. There is scope for the Reserve Bank to cut rates, but we can't declare victory on the progress of getting inflation down to a new target of 3%. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.